Hi, my name's Scott Dahl. Thank you for tuning in to another one of my podcasts. I'm recording on Sunday, March 16th. And what I'd like to do today is see if we can kind of determine where the support levels are. The question is, where's the bottom? Are we at a bottom? I'm going to try to answer that using technical analysis. Remember, I started this podcast building a basis in technical analysis and then sort of worked my way through to give you an idea of what I think is going to happen in the market, not only intermediate term, but long term as well. So a little bit about me, since it's been a while. I am a registered investment advisor. I've had my own company since 1996. I've been in the brokerage industry, or I started in the brokerage industry back in 1982, so over 40 years. I started reading charts when I was 16 years old, and it was a hobby. I would chart futures markets, and then that hobby obviously became a long-term career. I'm a chartered market technician. I was awarded that in 2001. I was one of the first 200 chartered market technicians. It's the highest accreditation you can get in the field of technical analysis. What I do for my clients is I take a very select few clients, and I approach it from a broad-based perspective. I see what they want to do, what they want to accomplish, and see if we can set their money up so they do exactly what they want in their lifetime and still have enough money to retire. So the planning process is a big part of it. But obviously, you need to be able to make money in the markets. And so I use technical analysis. And a technical analyst looks at the price, and they assume that everything that's happened fundamentally in that market or in that stock or in that commodity has everything that's happened fundamentally is in a pictorial form. What we're doing with technical analysis is we're looking at past price movement along with other technical indicators, looking for repetitive patterns, and then to try to determine what's going to happen in the future. Now, obviously, you can't predict the future, but the idea behind technical analysis is the market is a psychological mass. It's what every participant believes that the market, the stock, the commodity is worth at that specific moment in time. And we have this primordial need to herd. So that's what creates these short-term and long-term cyclical and secular movements that have a repetitive pattern. And that's what we're trying to do, is just look at this human psychology in a graphic or pictorial form. Now, I will say technical analysis is part art and part science. What I mean by that is science is looking at these technical variables and trying to draw conclusions, but the art is it's being in it a while and watching these patterns and seeing this repetition. And then it almost can at times sort of be like a gut feeling that you get from the experience of the markets over the years. So with that said, let's get going here. What I want to do is I'm going to introduce two more tools that I use. I've been using them for a long time that could possibly help determine where the support and resistance is in these markets and how far down can we go. The two predominant emotions that determine market movement are fear and greed. So we have at the top, we have a significant amount of greed. And the reason for that is, and this could be major tops, minor tops. The reason for this greed is because the news looks so incredibly good and people don't want to miss out. They don't want their neighbor to be making more money than them. So they continue to pile on as they follow each other into the market. And then when we see some type of stumbling like we saw to create this recent sell-off, the fear kicks in big and quick. And that's why tops are really sharp, because people want to head for the exits because the news starts to look bad or there's uncertainty. There's some reason why they want to get out. Maybe they have long-term profits. That's a possibility, some of these tech stocks. And that then as the market goes lower, there's more fear that perpetuates the selling. More people sell. The shorts come in, so people will start selling the stock. They can borrow the stock and sell the stock they don't have. And then what happens is after a while, you have the smart money. The institutions come in, they start to do buying, and they're not going to trade it out. What they're doing is they're adding to positions. They have a tendency to add to positions over a long period of time, and that's how they develop long-term good positive results. So those institutions would be considered the smart money. So the individuals are the weak hands. They do the wrong thing at the wrong time, typically. Good reason to work with an experienced investment advisor, because they understand, if they're good, they understand past emotional challenges and cycles, which should help. So let's get to these technical tools. The tool that I use to determine the overbought or oversold nature of the market, it's called RSI. That's an abbreviation for Relative Strength Index. It was created by a technician called Wells Wilder back in, I believe, the 70s, and it's an oscillator. And what I mean by that is it determines whether the market, again, is overbought or oversold. What do these terms mean? Overbought is there's just it's stretched. There are so many buyers that have come in, and eventually it'll run out of buyers. So what you want to try to do is determine that overbought nature. And then at the same time, now in referencing how far down are we going to go, we want to look at the oversold condition of the market. This is, again, Wilder's RSI. This is a daily chart of the Standard & Poor's 500. And here's the price action for the last 1, 2, 3, 4 days. And down along the bottom here, you can see that we have the months. And then along the top we have the price. And the Standard & Poor's 500 closed on Friday at 5,638.94. This white line is a 200-day moving average. We are below that, which is not a great sign. Also, this trend line, which I explained in the previous podcast, is slanted a little too high. I mean, that's a trend line, but that was the trend. It's been broken. So we've got air right down through here. Let's look at the relative strength index, the Wilder's RSI. This red line is 70%, and this turquoise line is 30%. So you can use this relative strength index to do different things. I simply like to use it as an overbought, oversold indicator. When the line goes up over this red 70%, the market's overbought. When it goes down to this turquoise line, which is 30%, or goes through it, the market's oversold. So you can see that the market is currently oversold at this point, significantly oversold at these levels. It's actually cleared, went down below the 30. And if you go back through the chart, here's another period where the market was 30 or below, and you can see that was a significant bottom. And here is another significant bottom when the RSI was low. And getting back over here in 2023, here was a significant low. You can see that this is a strong indicator. So obviously we're oversold at this point. So that's a positive sign for some kind of bounce here. Secondly, what I would want to do is I want to talk about Fibonacci retracements. Fibonacci retracements, it's a relatively big topic. So what I'm going to do is break it down and just tell you what it is simply and how we use it. If you go to Italy, if you go to Pisa and to the Leaning Tower of Pisa, there's a statue of the gentleman by the name of Leonardo Fibonacci. He was a 13th century Italian mathematician and philosopher. And what he discovered were reoccurring numbers in nature. There's a mathematical sequence. I won't get into it for this explanation, but it's based on what's called the golden mean, 61.8% or 0.618. And what he found was that rabbits multiply using the Fibonacci sequence. A Greek Parthenon was built using the golden mean. The pyramids were built using the golden mean. A sunflower has 89 petals, which is a Fibonacci number. It has 55 going one way and 34 going the other. Those are also Fibonacci numbers. You can go on and on. With that said, how does this transcend itself, or how does this move over to try to use it to determine market activity? Well, like I said at the beginning of this podcast, the market is a psychological mess. So I have put 3 of the most important Fibonacci demarcations or lines or numbers up on this chart of the S&P 500. So let's look at it. We're coming down here to, this is a 38% Fibonacci retracement, this dotted line here. This dotted line is a 50% Fibonacci retracement, and then this line is a 61.8 Fibonacci retracement. So it's basically 1/3, 1/2, 2/3. These have a tendency to be supportive to the market, and you'll use these particularly when there's really not a whole lot of previous support. The idea of support is that's where there could have been prior resistance. The price couldn't get through. When the price got through, it came down, and then at that point, this created support as the price moved lower. And it found support where it broke out of the previous resistance. If this sounds complicated, there are previous podcasts where I explain this in more detail. But let's look at these support areas. So this market it's stopped here. It created a little bit of a stop and a bounce. The support would have been here at these tops. It's penetrated that. So the next level of support I see is right down here in the Standard & Poor's 500. That's 5,371. That lines up with a 38% retracement, which is this line. Also, it lines up with these support areas right here. Well, they basically have come down to that 38% level, and they bounced off of it very handedly. And then if you get down here, this is 50% back. That was a major stopping point for the market. Also, this trend line here, this trend line, I'll make it smaller so you can see the price activity. That is the major trend line. That's about a 45% angle, which is normal trajectory. And if we cross that, we're in a bear market. So this 10% back correction, 20% back bear market. That was fabricated by the media. Those numbers mean absolutely nothing. I can tell you we're in a correction because we broke the prevailing trend. So those numbers mean nothing. So this is our ultimate support right down here in this area, which is right about 5,000, 5,060. We breach that, then in all likelihood we're going lower. So picking a bottom is like picking a falling knife. We don't know where we're going to hit here, but I still think we're in a bull market. We're in a cyclical bull market. And I believe that this is a correction in a cyclical bull market. We had very few corrections the last 2 years, so it's time. You have 74% of the time, you have a positive year in the market. You have 3 corrections, 5 to 10%, and then you have one doozy correction pretty much every year that's about somewhere between the 15 to 20% range. So all we're doing is we're correcting. And I believe that this market correction will purge the system, it'll clean it out, and then we'll go ahead and resume the uptrend with the caveat that there's certainly no person alive that's able to predict the future. But this is what I see. So the question is, what do you do here? Well, one thing you don't do is knee-jerk sell. Unless we break to a bear market, it's a different story. But when you have these drops, which appears to be a correction, if you knee-jerk out, if you go to cash, which a lot of people are doing right now, remember the investing public does the wrong thing at the wrong time. So if you go to cash, what's going to happen is you're going to miss these big up thrust days. As market will get oversold, you'll miss these big up thrust days. Your intermediate to longer term returns are going to suffer. So don't knee jerk out of this. What you do want to do is you want to cull your portfolio. Let me tell you what I mean by that. One of the greatest investors of probably all time, Warren Buffett, said, when the tide goes out, you see you swimming naked. So in a strong uptrend, pretty much most of the stocks are participating comfortably. But it's not like that now. What you want to do is you want to get rid of the laggards. So some of the holdings that have presented themselves in your portfolio have potentially presented themselves as stocks that really are weaker than what we had previously seen. You want to get rid of the weak hands, the weak stocks, and the stocks that are strong, that's where you want to move the money. So this gives you an opportunity to rotate out of the losers and rotate into the winners, or what's showing that strength, what's showing that they are the winners, and that's the way that you work your portfolio during these sell-offs. So when you come back even stronger than you were before. So how do you determine losers from winners? Well, losing stocks are the stocks that are losing what's called relative strength against other stocks. So the strong stocks will be showing strength against the other stocks in its universe. For example, the strong stocks in the S&P 500, you can see them. You can see the bases building. You can see the strength versus the other companies. So that's what you want to do, is rotate out of the weak, rotate into the strong. You don't need to revise your entire portfolio. You just need to reallocate some of the assets so you can put yourself in a position of strength for when this market recovers. If you have any questions, give me a call. You can reach me at 949-497-6366. It's scott@dahlcapitaladvisors.com. So I hope these are helpful. I enjoy putting them up. I'm looking forward to doing another one soon. Thank you again for tuning in, and see you on the next one.